So roughly 70% of homeowners that have a mortgage have an interest rate under 4%. You know what else they've got? A ton of equity. And these people are looking for ways to tap into that equity without having to touch that record low interest rate. One of the very popular ways to do this is through a home equity line of credit, aka the HELOC. In this video, I'm going to explain exactly what a HELOC is, give you the pros and cons, and share how you can get one for yourself if you'd like. But before I do, make sure to hit that like button, and if you're not already a subscriber to the channel, make sure to subscribe so you get more content like this. All right, what is a home equity line of credit? It is a second mortgage. So first off, you don't have to touch your first mortgage. So if you got a sweet rate, you don't have to touch that first mortgage. You can get a second mortgage. Now, a line of credit, the lender's going to approve you for a specific amount. Let's just say it was for $100,000. You don't have to take that $100,000 all at once. You can take a little bit of it, and then you can draw from that line of credit just like you would with a credit card, and your monthly payment is based off of the balance that you owe. Another thing that can be a benefit of a home equity line of credit is basically that monthly payment, that interest payment that you're making, it's interest only. So it's good and bad. The good side is that payment's going to be lower than what a principal and interest payment is, but you're not paying down your principal balance when you make those payments. But a home equity line of credit, it's a great way for you to be able to tap into your equity without touching that first mortgage. With most lenders, you need to have around a 680 or higher FICO score. You really want to have a 740 or higher though, so that you get the best financing terms. And typically the lender will allow you to borrow up to around 90% of what your home's value is. So for instance, if you owed $500,000 on your first mortgage and your home's value was $1 million, then you could borrow up to $900,000 combined. So that line of credit could be for up to $400,000 in this scenario. Now I get not everybody's got $1 million home, that makes the math easy though. So when it comes to the pros of a line of credit, it's basically that you don't have to touch your existing first mortgage, and you have flexibility in the money that you're pulling out. You don't have to take it all out at once versus a traditional second mortgage, which works a lot like your first, where all the money comes out at once and you got to make a payment based off of all of those funds. So like for instance, if you were remodeling your house and you knew that you needed $75,000 to complete the remodel, but it's going to take 6 months, well, if you pulled all 75 grand right out up front, you're going to pay interest for 6 months versus pulling out what's needed along the way, reducing your overall expense. So let's talk about the cons, the downside of the home equity line of credit. The main one is that it's adjustable. These loans aren't fixed, meaning that your interest rate can change, aka your monthly payment. And how do these things change? Well, you always hear everybody talking about the Fed raising the rate. This, in fact, is a time in mortgages where the Fed does control that rate that you're going to get as a consumer. Now, the Fed doesn't control first mortgages. That's a misconception. But lines of credit are always based off of the prime rate, which is tied to the Fed rate. And so like coming up when the Fed raises the Fed funds rate by 0.25%, if you have a home equity line of credit, your rate just went up by 0.25% along with your credit cards and other unsecured debt. Another downside to a home equity line of credit is the way that they typically work is that they're amortized. It's a 30-year loan where you can pull from that credit line for the first 10 years, but then you got to pay the money back at that point. And the downside to this model is that basically at that point, you'll have a 20-year loan. So you won't have a 30-year payment, you'll have a 20-year payment to pay off that amount. Well, a 20-year payment, that's going to be higher monthly payment. So a lot of people have payment shock when that happens. What most people ultimately end up doing, by the way, when they have a line of credit is down the road, when interest rates become favorable enough on first mortgages to combine those debts together, they typically will do a debt consolidation refinance, pay off that line of credit with a new first mortgage. Another pro of a line of credit is that it's a loan. So this isn't income. When you pull money out of your property to pay for things, you're not paying income taxes on that money. Now, I'm not a CPA, nor do I play one on YouTube, but look it up, that's how it works. You can use the funds for whatever you want. Most people use their line of credit funds for big purchases, remodels, weddings, college, those kinds of things. If you were crazy, you could take a vacation with it. We don't recommend using your home equity to pay for stuff like that, but the point being, you can do whatever you want with the money. Another way that a lot of people are using lines of credit is to get their down payment ready for their next home purchase. If you own a house, a lot of people want to use their equity as a down payment on the next house. But wait, you got the chicken before the egg. How do I get my equity out for the down without selling my place first? Well, the line of credit can be a good solution for that. So there you have it, the HELOC, the good, the bad, the ugly. If you want to get a quote for a HELOC yourself, go to newwayquote.com. If you got questions about HELOCs, put them in the comments below. I'd love to answer it. Maybe I'll make a video about it.